Let's talk about Wall Street getting a bit more bullish here on the outlook for stocks. A slew of big banks hiking their S&P 500 year-end targets this week. The latest is Citi. Citi boosting its forecast to 5,600. That's up from 5,100. Here to discuss the latest call, we want to bring in Scott Chronert. He is Citi's head of U.S. equity strategy here. Scott, it's great to see you again. So much of this, I was going through your note out this morning, much of this being attributed to that outsized performance that we've been talking about of large cap tech. So walk us through your thesis and why you think there's still more room to run here to the upside.
Yeah, so I think what's happened is that if you look at the S&P performance so far this year, let's say we're up 14% or so, you can really break that performance into three categories. One is Nvidia, which has contributed about 5 percentage points of the index move year to date. About 4% comes from the other of the Mag 7, and then about 5% from the other 493. So really what's happened is a function of index weighting math, is that you've had this unique situation where this mega cap growth cohort has been responsible for a big chunk of the index performance this year. And notably, it's been supported by an ongoing beat and raise dynamic, which has not been true for the other 493. So where do we go from here? Well, we think that the fundamentals, certainly for the second half of this year, continue to be in very good place for this mega cap growth leadership. So we expect a continued positive follow through from an earnings perspective there. As to the remaining 493, we're in a okay place. So far, it looks as if a 6% earnings growth for that cohort's in the cards, but we think that there's room for that to broaden going forward. All told, when you put all this together, I think we're I think on a pretty good footing here to take our target up to this 5,600 level, which is relevant to $250 worth of index earnings, and we give it about a 22 times PE.
And so when you think about and really kind of evaluate what the earnings and the guidance has looked like coming from companies going into, and really once we finally kick off the Q2 earnings season here, what are you going to expect to hear from companies, especially as they're trying to best deliver to investors what the demand situation looks like from their perspective that would actually contribute and deliver on some of those earnings promises?
Okay, so you've got two things going on, and the first is what you were alluding to earlier in your program on the retail sales data, right? So I think under the surface, we think that there's a fraying around the edges on the economic condition. If you go back and think about the Q1 reporting period, most C-suites were fairly constructive, or let's call it cautiously optimistic regarding outlooks. We're going to be watching that pretty closely. I think in general, what we're going to see as we go into the Q2 reporting period is a little bit more evidence that the lagging effects of Fed rate hikes to this point is starting to weigh on fundamental activity. So we have to be aware of that. In the meantime, we do think that this AI driver is going to continue to spur a lot of activity on the investment side of generative AI, and that should continue to feed through to a certain degree into the Mag 7, but we think that there's a broadening effect as well. So on the one hand, you've got signs of fraying economic activity. On the other hand, we have this new growth driver in town. The combination of the two, I think, is going to give C-suites, generally speaking, two ways to talk about this. Yes, some concern short term, but longer term, we think there are really interesting growth opportunities unfolding courtesy of this generative AI angle.